What headwinds do you see for the sector? Because we know that they're warning us about them.
Well, I got to tell you, this is one of the wackiest quarters that banks have reported in a long time because, you've got a whole series of one-time events that were created obscuring the fact that the core businesses of these companies didn't do that well in the quarter. In other words, because the whole yield curve went down in value, went down in yield, you got a situation where banks made a lot of money on the fact that, they have $3.5 trillion in aggregate in securities that they own. Second thing that happened in the quarter was you got this big increase in IPOs, and these IPOs did reasonably well, and these banks own a piece of those IPOs, and they also do these green shoes when you get a strong offering, and they make quite a bit of money on that. So if you look at the earnings of the companies, they're being, as I say, obscured by the fact that they're showing big gains, from their investments and their trading positions, and they're, also on top of that, in some cases, showing big drops in their tax rates. I mean, JP Morgan's tax rate is dropped below 15%. So the net effect is, that allowed all these companies to show, better earnings than were estimated. But if you go behind these numbers, you can see that loan volume increased at a relatively low pace in the quarter. You can see that there was pressure on their net interest margins, and you can see that if the bank was involved in trading or in investment banking, without adding the benefits that they got from the green shoes, et cetera, the investment banking area was not good. So, you have to separate the one-timers, and when you do that, you have to say that banks were moderately positive in the quarter and not terribly exciting.
Okay, so even if you take out the one-time items, one of the things that is not a one-time risk, it's a sort of an ongoing risk potentially, is what the Fed is going to be doing. And are we going to be getting, it seems as though we are going to be getting more compression for the banks as the Fed cuts rates, or am I missing something? Is that going to help them?
Well, it actually is going to help them right now because, basically, if you, and I know this whole interest rate thing with banks is a difficult issue to deal with, but the first thing, if we separate from the net interest margin for a minute and just look at the bank balance sheet, if you own, $3.5 trillion worth of securities and interest rates go down, you're going to see a pretty big increase in your unrealized capital gains, which, we did see and we will continue to see if interest rates were to continue to fall. If you then take a look at the operating part of the business, you have to say, okay, what's happening to the yield on loans and what's happening to the cost of deposits? And quite frankly, in the quarter, the yield on loans came down a bit for some banks, for example, JP Morgan, and the cost of their deposits went up. So if the Fed were to cut rates, my guess is the cost of deposits would stop going up, and these guys would stop, if you will, this brutal competition in pricing of the loans, and maybe interest rates margins would stabilize. But 99.999% of the people who follow this industry would argue that view is wrong, and that if you get, JP Morgan was talking about 3 interest rate cuts this year. If you get 3 interest rate cuts this year, it's going to harm net interest margins. And since 99.999% believe that, that's what's going to drive the stocks, not what the reality is.
Okay. Dick Beauvais, the Rafferty Capital Markets analyst, we appreciate your being here on The Move.